In 2025, global gold demand didn't just rise, it crossed a psychological line. The world consumed more than 5,000 tons of gold in a single year, valued at roughly $555 billion. And that wasn't driven by jewelry trends or a seasonal rush in coin shops. It was driven by the kind of buying that doesn't pose for cameras and doesn't ask for permission. Not months, not weeks. It is because when the asset that central banks treat as final payment starts moving in size, it compresses time. It makes slow politics feel fast. And it makes comfortable theories feel fragile. For years, the official story was simple. Modern finance is built on trust, liquidity, and deep markets. Gold was a relic, a hedge for nervous people, a shiny commodity with a nostalgia problem. And then the data refused to cooperate. 3 tons of net buying in 2025. That is not a hobby. That is a policy choice. They said the world had moved past metal. They said settlement assets were obsolete because promises could be cleared instantly, rehypothecated endlessly, and collateralized into infinity. But when official buyers keep choosing bars over paper, they're not making a style statement. They're revealing what they think counts when the lights flicker. Here's where it gets interesting. The institutions making these moves don't announce them as a pivot away from promises. Small words, comfortable words, but the behavior is loud, and behavior is the only language settlement understands. Welcome to Settlement Signals, where we decode what matters before it becomes a headline. If you've ever felt like the story changes only after the big players have already positioned, this channel is built for you. Subscribe the way you'd keep an empty chair at the table for the wise elder who shows up late but always knows what just happened. And tell me where you're watching from, because the settlement map looks different depending on the passport in your pocket. Now let's talk about the event that exposed the central mystery. In early 2025, the full year numbers for 2024 landed, and they landed like a warning flare. Central banks had quietly absorbed 1,045 tons of gold. That's over 33 million troy ounces. At roughly $2,000 an ounce, that's around $66 billion. But the number matters less than the intent. Central banks can buy anything. They chose the asset that has no counterparty risk. Then, in 2025, investment demand didn't merely recover. It jumped 84% to 2,175 tons. In plain language, private capital began to mirror official behavior, and the combined result pushed total demand past 5,000 tons. That's not a gentle shift. That's a change in preference. At the same time, the vault data in London, the heart of the global bullion clearing system, showed 9,106 tons of gold sitting at the end of December 2025, $261 trillion, and the count was roughly 728,712 bars. Those aren't just bars, those are receipts. Those are the physical endpoint that paper claims are supposed to reference. So why does this matter? Because while the world is distracted by interest rates and elections, the real question is, what do nations want in settlement when promises become negotiable? To understand that, you have to look at the moments when the world made the same choice before. In 1933 and 1934, the United States effectively rewrote the terms of gold and the dollar. The details are complex, but the pattern is simple. In a crisis of confidence, the authorities moved to control the settlement asset, then redefined the price relationship to regain breathing room. The outcome wasn't just a policy tweak, it was a monetary reset that changed what a dollar meant. In 1968, there was another rehearsal that most people forget, the London Gold Pool. A group of Western central banks had been supplying gold into the market to defend an official price, essentially using official metal to stabilize a promise. The arrangement held until physical demand overwhelmed the ability to supply at the fixed level, and the pool collapsed. The market split into a 2-tier system with an official price on one side and a free market price on the other. That is the fingerprint of a system trying to keep promises stable while the settlement asset insists on a new price. In 1971, the playbook returned. The official promise was that foreign governments could convert dollars into gold at $35 an ounce. That promise worked until it didn't. When the claims on gold grew larger than the gold itself, the United States closed the gold window. The story is often told as a political decision, but structurally, it was a settlement decision. The world had been using dollars as promises of convertibility. The moment convertibility ended, the world learned what kind of promise it was holding. And in 2008, the crisis didn't center on gold directly, but it did center on the same underlying tension. What happens when paper assets that were treated as safe and liquid suddenly behave like trapped doors? In that period, central banks expanded balance sheets, collateral rules changed, and the definition of good collateral became a live wire. The result wasn't just a recession. It was the normalization of extraordinary monetary intervention. There were smaller, sharper echoes too. In 1997, the Asian financial crisis showed how quickly money can become geography. Countries that looked stable on paper discovered that offshore dollar funding could vanish overnight. And once that funding vanished, assets that had seemed liquid became trapped behind exchange controls. In 1998, the long-term capital management rescue reminded markets that leverage is only comfortable while counterparties keep their promises. When counterparties hesitate, even trades designed to be low risk can become unstable. More recently, modern exchanges have shown what it looks like when a market chooses stability over strict enforcement. In March 2022, the nickel market on the London Metal Exchange experienced extreme price action that led to trading halts and the cancellation of trades. Whether someone agrees with those decisions or not, the lesson is simple. In a stress event, rules can change faster than positions can. Paper exposure lives inside a rulebook, and the rulebook belongs to institutions. Precious metals have their own version of that lesson, and it often arrives through margins. When an exchange raises margin requirements, it doesn't need to ban a trade to change behavior. It simply makes the trade more expensive to carry. That shifts who can participate, what time horizon survives, and how quickly positions must be closed. If the underlying physical market is tight, higher margins can suppress the paper price temporarily by forcing liquidation, even while physical buyers keep paying up in the real world. All of this points to one reality. A promise is valuable until it meets a boundary. The boundary can be legal, political, or mechanical. It can be a sanction list, a capital control, a clearing limit, or a margin schedule. A settlement asset is what remains valuable after the boundary appears, because it doesn't need permission from the boundary to exist. And that is exactly why metal keeps re-entering the conversation at the highest level. When the world is calm, the distinction feels academic. When the world is stressed, that distinction decides who gets paid, when, and in what form. Now look at the current era. In 2024 and 2025, you see the same logic, but expressed in a new language. Instead of closing a gold window, nations build alternatives to dollar clearing. Instead of announcing a revaluation, they accumulate settlement metal quietly. Instead of saying, we don't trust the system, they change the system around their distrust. This is the part no one is discussing. Settlement is not a moral judgment, it's a survival function. If you're a nation, you don't get to be wrong about settlement assets. If the asset you rely on can be frozen, sanctioned, delayed, or politically conditioned, it is not settlement, it is permission. So who are the players moving first? Start with central banks. The official sector is telling you that the definition of reserves is changing. Gold sits outside the credit system. It is nobody's liability. A bond is a promise by a government. A bank deposit is a promise by a bank. Even a currency swap line is a promise with conditions. Gold is a thing. Now add the regulatory and policy layer. The Bank for International Settlements rarely makes headlines, but it shapes what counts as safe in the banking system. After the global financial crisis, the rules pushed banks to hold higher quality liquid assets, and central bank reserves sit at the top of that hierarchy. But reserves are still claims on someone else's central bank. They are still a line in a ledger that can be restricted. Gold, stored domestically, behaves differently because it is outside that chain. Then look at the infrastructure institutions. London vaults, clearing banks, and the machinery that turns bullion into settlement are not neutral. They are plumbing, and plumbing is power. A system that relies on vaults and clearing rules can be stable for decades, then abruptly become political when access changes. That is why custody and location are becoming strategic. Now layer in the trade corridor data. By 2024, more than 95% of trade transactions between China and Russia were reportedly settled in yuan and rubles, not dollars and euros. That doesn't mean the dollar disappeared. It means that for that corridor, the dollar stopped being the default settlement language. And once one corridor flips, others study the move. There's another clue that looks small until you place it in context. Reports surfaced that China bought about $961 million in gold from Russia in November 2025, following roughly $930 million in October. Those are not retail numbers. Those are settlement numbers. When trade partners under pressure move value through metal, they are reducing dependence on intermediated promises. And then you have the sovereign and quasi-sovereign entities. Wealth funds, state banks, and strategic reserve programs don't chase momentum. They minimize regret. When they accumulate metal and diversify settlement paths, they are telling you what kind of risk they think is rising. The risk of being paid late or being paid with conditions. Now let's get even more specific about the institutional movement. It's not only central banks buying, it's also the way custody is changing. Countries have repatriated portions of their gold reserves over the last decade, and even when they don't announce repatriation, they diversify storage locations. That is a way of lowering jurisdictional risk. When custody becomes a strategic decision, it's because promises are being treated as conditional. On the market side, bullion banks and exchanges respond by adjusting the plumbing. You'll see it in the fine print. Tighter rules around eligible bars, changes in delivery points, adjustments in how exchange for physical transactions are handled, and crucially, the preference for netting and cash settlement when physical flows get stressed. These are not conspiracies. They are risk management. But risk management at scale becomes a signal. Here's the dislocation that makes this all unstable. Paper markets are designed for liquidity and price discovery. Physical markets are designed for delivery and finality. In calm times, they align closely enough that most people treat them as one thing. In stressed times, they diverge. On one side, you have paper claims, futures contracts, options, unallocated accounts, and derivatives layered on top of metal. These instruments can multiply the apparent supply because they are promises to deliver or promises to pay the difference. They allow a vast amount of trading with relatively little physical movement that creates tight spreads, deep volume, and the illusion of infinite availability. On the other side, you have bars and vaults, shipping schedules, assay capacity, and the simple fact that a bar cannot be in two places at once. Physical markets care about purity, brand, location, and title, and when demand becomes settlement-driven, those details matter more than the headline price. It shows up when one region pays above the global benchmark for immediate metal, while another region shows calm paper pricing. It shows up when the futures curve suggests plenty of supply, but the people who actually need bars start asking different questions. What form? Which vault? What title? What notice period? That gap cannot persist indefinitely because paper claims ultimately reference physical deliverability. If too many participants want conversion at the same time, the market is forced to choose. Raise the price sharply to ration demand, change the rules to slow conversion, or push settlement into cash instead of metal. Every one of those outcomes is a signal that promises have limits. Let me show you what this actually means with a simple anchor. London's end December 2025 vault figure of 9,106 tons sounds enormous, and it is. But remember what the market does with that number. The same bar can support multiple layers of claims if it is held in an unallocated structure, leased, swapped, or pledged. The difference between allocated and unallocated is not trivia. It is the difference between ownership and a claim. If you're holding allocated metal, you own specific bars. If you're holding unallocated, you hold a promise from a bullion bank, usually backed by the bank's general pool. In normal times, the promise is fine. In stress times, the promise becomes a queue. And queues are where reputations are tested. This is where the East-West story becomes more than a cliche. Western benchmarks have historically dominated pricing, but Eastern demand has increasingly dominated marginal physical flows. When physical demand concentrates in regions that care less about paper leverage and more about immediate delivery, the benchmark can lag reality. That's why premiums in certain hubs can persist, even while the global headline price looks orderly. Orderly prices can coexist with stressed supply if the stress is in the deliverable category that matters. So the real dislocation is between two kinds of truth. And when those truths diverge, settlement assets start to outrank promises, because settlement assets resolve the argument. Now, if the official sector and large institutions start preferring settlement assets, they start preferring allocated, segregated, or domestically stored metal. That changes the availability of metal for the paper system. It tightens the free float that supports liquidity. And when the free float tightens, paper pricing can remain calm right up until it breaks violently, because paper markets can postpone reality until the moment of delivery. This is the mechanism, and it's not mysterious. It's bureaucratic. It's implemented with forms, margin schedules, and clearing rules. First, margin. In leveraged markets, the price is not just a reflection of supply and demand, it's also a reflection of who can afford to hold positions when collateral requirements change. When exchanges raise margin requirements, they force participants to post more cash or liquid collateral. That often triggers forced selling, not because the thesis changed, but because the balance sheet can't carry the position. The selling pushes the price down, which looks like the market rejecting the asset, even if the underlying demand hasn't changed. Second, settlement options. Many contracts allow cash settlement, exchange for physical mechanisms, or alternative delivery arrangements. Those are safety valves. There are also ways to manage a shortage without admitting a shortage. If a market can settle in cash, it can avoid delivery stress, but it also creates a subtle message. The claim is not the thing. Third, location and form. A 400-ounce good delivery bar is not the same thing as a kilo bar for certain buyers, and neither is the same as coins. When demand shifts towards certain forms and locations, supply can appear ample on paper while the deliverable category tightens. The benchmark price may not reflect the bottleneck until the bottleneck becomes acute. Think of it like airline seats. An airline can advertise a flight as available, and technically it is, because there are seats in the back. But if a corporate traveler needs a specific class of seat at a specific time with specific change rules, the availability becomes a different reality. Settlement works the same way. A promise to deliver gold is not identical to immediate delivery of specific bars in a specific vault under specific title. Now connect that to why nations prefer settlement assets over promises. Promises are convenient when the system is stable and the referee is trusted. But in a world where reserves can be frozen and payment rails can be weaponized, a promise issued inside a jurisdiction becomes a geopolitical instrument. Metal, held in your own custody, is not a tool of someone else's policy. That's the pivot. It's not that gold is returning because people fell in love with history. It's returning because settlement is becoming political again. And when settlement becomes political, the market starts to reveal contradictions. Officials talk about stability, but reserves behavior says contingency planning. Public messaging talks about confidence, but vault behavior talks about control. Paper markets talk about liquidity, but physical logistics talk about scarcity in the places that matter. The data suggests the next phase isn't about a single dramatic announcement. Historically, it unfolds through a sequence of small decisions that only look connected after the fact. Scenario 1, the conservative path, is that the system absorbs the shift without rupture. More trade is settled in local currencies. Swap lines expand, gold reserves continue rising, but slowly. The benchmark price rises, but in steps, and volatility stays contained because the market keeps finding ways to clear. Scenario 2, the moderate path, is that dislocations widen. Regional premiums persist, leasing rates and custody demand rise. More institutions demand allocation and domestic storage. In that environment, the price doesn't just drift up. It reprices in bursts, because each burst is the market discovering the marginal bar that is actually available for settlement. Scenario 3, the aggressive path, is that a major corridor experiences a settlement stress event. It could be triggered by sanctions, by a banking disruption, by a sudden shift in capital controls, or by a liquidity event that turns collateral into a cliff. In that case, the world doesn't run out of gold. It runs out of trust in certain promises. And when trust breaks, prices move not because of greed, but because of urgency. What should be watched isn't the daily chart, it's the plumbing. Watch for persistent gaps between regional pricing, not for a single spike. Watch for changes in collateral rules, margin schedules, and settlement terms. Watch for official sector buying that continues even when prices are high, because that signals that price is not the main variable. And watch for trade settlement language, because when trade stops using a currency by default, that currency's promise changes. This is not opinion, this is pattern. When claims multiply faster than the settlement asset, the system eventually rebalances. Sometimes that rebalance is elegant, sometimes it is chaotic, but it always rewards the institutions that moved before the explanation. And that brings us to the choice ahead. The divide is not between people who are smart and people who are not. It's between people who watch narratives and people who watch settlement behavior. Because narratives can be rewritten overnight. Settlement cannot. Institutions move first because they are responsible for continuity. They don't wait for consensus, they wait for risk. When they shift toward metal, they are telling you that the probability-weighted cost of being wrong about promises has risen. Retail, by contrast, moves last because retail is trained to look for confirmation, headlines, permission, certainty. But certainty arrives after the price changes. That's how the wealth gap becomes an information gap and then becomes a timing gap. So the question isn't whether the metal-backed pivot is happening. The numbers say it already is. The question is whether the world keeps sliding toward settlement assets, or whether it finds a new way to make promises feel like final payment again. This is Settlement Signals, where we decode what matters before its headlines. If this connected dots you hadn't seen, you know what to do. Because the question isn't whether this unfolds. The question is whether the world is positioned before it does.